Okay, well, welcome everybody. Very happy to have you here with us. This is Wednesday, December 14th, 2022, and we are doing this recording and this webinar probably for the last time ever. Are we doing a webinar at 4 p.m. because I am in the process of discovering exactly how difficult it is to change from trading mind to speaking mind. So if I am semi-coherent or, I don't know what happens, whatever happens over the next hour, bear with me and accept apologies in advance. But we had a little Dropbox conflict here with the slides, and I think we're set now. So just kind of to orient yourself, if you have questions as we go along, type them into the question box. I'll try to stick around and do a decent amount of Q&A, but we'll see where we end up. And if you type questions, I might not get to every question, and I might hold all of the questions to the end, but feel free to use the question box anytime you wish. Okay, so thank you. Thank you for joining me and giving me time to share some thoughts and ideas with you. And this is a topic I've been thinking about quite a bit lately, and it doesn't sound exciting. In fact, when I talked to some of our marketing folks about, hey, I want to do a webinar on rules, of course, like, wow, that sounds really exciting. Let's talk about rules. But this is in my own trading. I've been thinking quite a bit about how to structure the formlessness and in some ways structuring the unstructurable with like what's the right way to do that? How do we do that? How can it go wrong? How does it go wrong? So the end result of a few months of thinking intensively about this topic is what we're going to do here today. And what I hope to do here today for you is to really do two things. I want to Ideally, I'd like to inspire you, but I'd settle for provoke, okay? So if I can provoke you to think about information and stuff that you encounter out there in a very critical way. And we'll start right here at the beginning with looking at some things we can take apart critically. And of course, the second goal is to help you really craft a rule set that will help you trade better, will help you make more money. We're not talking here about a trading plan. This is, kind of a separate silo, but this is one of the things that goes into the trading plan. And right here, as I'm talking to you, I'm looking at one of my monitors, and I have taped a rule to the side of this monitor. So, every time I look at this monitor, I'm seeing a rule, and the rule that I'm seeing right in front of my face right now says fix mistakes immediately. So you might also you might take away some things here that in a very practical way you can use to nudge your own trading in some good directions. So how we're going to get there? Well, one of the things that Mark Douglas book on psychology, one of the things that really hit me the first time I read it, I do think it's a good book, everybody should read, but he talked quite a bit about how we can do anything we want in the market. There are no rules. And that's not necessarily a great thing because we fight against rules. And most of us have fought against rules from childhood. And the only rules that exist in the market are the rules we make for ourselves. Now, I also have realized that, and most of us realize pretty quickly, natural trading leads to disaster. What you will find is if you sit somebody down and you give them a little bit of basic orientation and like just a basic understanding of the market, like you could get in a couple days, and then you said, here's a trading platform and here's real money, do your best. What you're going to find is that that person is going to do the wrong thing a remarkable percentage of time. They're going to Market's going to rally, they're going to chase, they're going to buy, they're going to have bought at exactly the wrong time. And of course, the same thing to the downside. And they're going to make just amazingly wrong decisions. So we do need rules to, and today we're going to talk about why that's true. Why what I just said happens. Why is it like that? Why does it have to be like that? And if we have the right rules that will point us away from that natural disaster that we tend to make out of ourselves as traders, then we have a chance. The question, of course, is what are the right rules? Let's look at some trading rules. You've heard these. I know you've heard these because these are out there everywhere. Buy low, sell high. You got to take every trade your system gives you. Or sometimes people might say, maybe you should only take the very best trades. Those are kind of opposite, right? That's one of the things, if you, again, put yourself in the mindset of somebody who knows nothing about trading, and you decide, hey, I'm going to learn how to do this. So you go and you look at what people are saying about trading. What you're going to find is right away, there's a lot of conflict. You're going to hear a lot of conflicting advice. This is a good pair, right? Take every trade your system gives you. Be very discriminating. Take only the very best trades. Okay, what? Enter early, but not too early. Never add to losers. Or, there's another way to say this is losers add to losers. A lot of these things kind of have nice, little memorable ways to say them. No one ever went broke taking a profit. Always look for trades where your reward is larger than your risk. And ideally, we'd like to have 3 times our risk, 3 times our reward as our risk, or maybe 5 times or whatever, right? The first loss is the best loss, or, one of my favorites is don't lose money. Now, a lot of these have very good pedigree behind them. That last one, I think, is often attributed to Warren Buffett. Never add to losers is, there's a picture of Paul Tudor Jones that goes around. And who am I to say that Warren Buffett or Paul Tudor Jones is wrong? That's obviously kind of ridiculous, but I am going to say that. I'm going to tell you why. So those of you who have seen and listened to other presentations I've done, this is a remarkable presentation, I think, for one fact. It has one price chart in it, and you're seeing it right now. So this idea, buy low and sell high. This is a trading day from this week. And let me show you where the best trades were. Buying here. These were trades that we did, buying here, and then buying somewhere here. So if you look at this, don't look at the whole chart here. When you look at this first arrow I drew, this was the high of the day. We were buying at the exact high of the day. And the rule is buy low and sell high. And then here again, at the end of the day, we were buying at what at the time was the absolute high of the day. And another way to look at this buy low, sell high rule is, one other way to do it is to buy high and sell higher, right? And of course, you can flip that and talk about selling in the same way. But if you applied nothing more than buy low, then you're never going to be able to buy anything in here, and you're certainly never going to be able to make any long trade in here. And arguably, maybe there at the end you'd like to have been selling, but whatever. So the issue is, and the reason why that set of rules I just showed you is a silly set of rules. And again, you've heard those everywhere. In fact, when I started to write this PowerPoint, there are some educators who just spout things like that endlessly. And I said to Tom, hey, what are some trading rules that are probably good, but they're stupid in some cases? And Tom said, let's go to this website. So I've already been there. That's where. So like some people produce and just throw these things out, and they can sound very wise until you dig down into them. And the issue really is that there are a lot of different ways to trade. There's not one correct way to trade. The Jack Schwager quote says something like, there are thousands of different ways to make money in the markets, and the apparent paradox is that those are all very hard to find. I think that's one of the coolest things I've heard anybody say about markets. Is absolutely true. You can trade different time frames, you can trade different styles, you can trade different instruments. So why would you think that I could give you a rule that would apply to somebody who's making 20 trades a day on a 1-minute chart of an option, why would the same rules apply to that person that would apply to somebody doing value investing, where they're buying the company and basically hoping to hold the company itself for decades? Very, very different approaches to making money in the markets. So it's silly, it's beyond silly to think that same rules should apply to all styles of trading. For instance, this never add to a losing trade. As I said, that comes from Paul Tudor Jones. And what I believe he was doing at the time was he was very good at picking off reversals. So you would have a market like crude oil or gold that would be going down, and he would find conditions that showed him that he thought that market was at an absolute low, and he would buy it. And what he said, that nobody, everybody would say that he was the guy who bought the exact bottom in crude oil, but what nobody would say is that he tried doing it 6 times before he got it right. So if you think about that, then all of a sudden, oh, it snaps into focus, doesn't it? Because if you're doing that, if you're looking at picking off the exact bottom in a declining market or shorting the exact high in a rallying market, if you add to your losing trade, you're going to get run over, you're going to get destroyed. You got to be in, and then when you're wrong, you're out, you try again. That's absolutely correct. On the other hand, there are styles of trading that rely on scaling in when you're wrong, and different kinds of mean reversion trading, where the market's bouncing around and you're shorting when it goes up and you're shorting more when it goes up against you. You can't do that kind of trading unless you can add to a losing trade. It is the key to making it work. So there's a rule that would absolutely prevent you from trading certain kinds of markets. A lot of what passes for trading sayings are just definitions. It's kind of dumb. Here's a dumb one that I used to say all the time. I would tell people, because one of the main ways I trade, I'm a pullback trader, and I would tell people that the best pullback in a trend is the first one. Really? And I would tell people that like I thought I was imparting useful information. So you have a market that you look back over 6 months and it's done this, and then I'm going to tell you the best pullback to buy was this one. Yeah, of course, right? But there actually might be some useful information there if you think about it, because if you had a market that was doing its trading range thing and then it broke out and makes something that looks like a pullback, that would tell you that, hey, this structure here, maybe we're looking at something like this. That's what we would hope for, right? Maybe this ends up being the first pullback. And it might also give us some insight that these further pullbacks are likely to be a little riskier. Maybe we need to manage them a little bit differently, think about our position size a little bit differently. So it's not a totally useless thing, but it doesn't really tell you a lot of information. Your first loss is your best loss. Well, that's for many people holding cryptocurrencies, that's not particularly helpful information today. Might have been several quarters ago. Enter early, but not too early. What does that mean? So if you think about these, we don't need to tear all of these rules apart. If you think about, as I've been spending a lot of time thinking, what are useful rules? I think there are 2 levels of useful rules. One is this universal level. I think this is dangerous because we can almost always shoot holes in these. There are very few things that apply to all traders, all time frames. If you have somebody who is selling options with 0 days to expiration, or somebody who is looking at pair trades in stocks, it's going to be very hard in both of those cases to find things that speak equally to those 2 kinds of trading. There are a few though. These things, when we do find them, are unlikely to change, and they very likely represent a core set of knowledge, or maybe a core set of behaviors that successful traders need to drive toward. And the second is what I'll call my rules. These are rules that are specific to the way I trade. They're specific to my personality. They're probably specific to my life situation, literally my, the state of health of my body, where I live in the world, what I have, the number of distractions, the kinds of distractions I have outside or in market hours. They might very well be specific to a certain issue or problem. Is there something in my trading that is irritating me or costing me money that I need to change? And these rules are likely to change over time. So there's no reason, if I share a list of rules, which I'm going to do today at the end of this presentation, I'm going to share a list of rules that I use. There's no reason to think necessarily that this will apply, all these rules will apply to me with no change a year from now. And there's very little reason to think that they will apply to you. So what you have to do to get something useful out of this is to understand what we're trying to drive toward, what we're trying to structure. And as I've said here, the rules behind the rules, I think these are universal. I think these are the rules that basically stand behind any successful trading approach. And these are, if you don't understand the game, you're going to lose. You don't know the game you're playing. You don't know how it's played. You don't know the rules. You don't know the other players. You're probably not going to make money at best, and you're probably going to lose. Successful traders embrace uncertainty. In some ways, maybe even seek out uncertainty. Knowledge is not enough. All that matters is what you do, not what you believe. No one cares what you believe about trading. All that matters is when you push the button, when you get in and out of trades. The key to discipline, and this is kind of a new thought for me. This is maybe not fully formed, so I'll appreciate, you're seeing some of my kind of evolving thinking here. So I apologize if some of these things aren't super clear, and maybe I would be able to articulate them a little bit better 6 months from now. But I wanted to share these thoughts as I'm kind of putting them together. And we talk a lot about trading discipline. I think one of the reasons trading discipline is so hard, not just because it's hard to be disciplined. It's not really in some ways, right? Like you drive on the correct side of the road, depending on where you are in the world. So, you can maintain certain kinds of discipline. But I think a lot of trading discipline comes down to understanding what you can do. There are certainly limits to what you are able to do, and then to understand what you are responsible for. And if you can kind of knock those things into alignment, then you find that things will get a lot better. And the market is the ultimate scale of justice. That's where we're going to end up here. So as far as understanding the game, what's the market? Well, what we call the market, and some of these points, by the way, are rules that are actually on in my trading plan and in my rule sheets. And some of these have been on my sheets since like the mid 1990s. Some of these are old friends. And like this particular line here, what we call the market is the end result of uncountable conflicting influences. This is very important to remember. It seems like sometimes there's great intent in price action, but there's also a lot of things bouncing around and a lot of conflicting things happening. And so much of what we see in the market is noise. And once you take the noise out of the market, the literally random movement, come back to that. Once we take that out, then a lot of what we have left is deception. Andrew Lowe, I've talked about this before, one of his ideas, which I don't know how much has been done with this recently, someone can maybe look into it, is the adaptive market hypothesis. The idea that markets you can essentially think of them as ecosystems with predators and prey who are evolving deception, just like you have moths that over time evolve bird eyes on their wings so birds don't eat them, or animals evolve different poisons or spikes or things to protect themselves. And in the market, you have this kind of ongoing evolution that's centered around deception. You certainly see this in the order book. You see this with iceberg orders. It's a very real part of what we all experience in the market. The market is also extremely competitive and is very, very nearly completely efficient. That is something that drives toward reminding us how difficult it is, how difficult it is to make money in the market, and how important it is that we have a very cleanly defined edge that we can apply with utter discipline. But here's a big one also. Despite all of this, the fundamental nature of price changes in financial markets has not changed over the complete history of recorded price changes. And this goes back to, we can go back decades, we can go back centuries, we can literally go back to antiquity. And you will see that markets have done their same market thing and continue to. There's a great deal of stability in the way markets move. And people don't want you to think this, right? Because a lot of people will talk about how edges go away, and they do. Specific edges do go away. You can publish a trading system and it will stop working. A lot of things in academic papers don't work the week after they're published. They don't work, and that's just the nature of how specific edges flex and change over time. But there are ground essential ways that price moves. We'll talk a little bit about that in just a moment, that have not changed, and there's no reason to think they'll change. You got to remember that what you are looking at is not the market. What you're looking at when you look at a chart, or if you look at whatever tool you're using, market profile, depth of market, if you have an algorithmic rule system, so many traders don't even actually see market data. They craft a set of rules and then they look at the trades that system makes. All of this is just a representation. And the little picture here, you've heard the saying, of course, don't mistake the finger pointing at the moon for the moon itself. A lot of people do this. A lot of people get very, very focused on some silly pattern. Edwards and McGee did it. And this is one reason why you don't hear me talk a lot about classical chart patterns, because if we focus on them, we're focusing on the wrong thing. It's not the idea that we need to trade a shape in the market, or even an event that happens in the order book. It's that what we need to do is to trade the underlying essence of what the market's trying to do. Trade the you're basically trading against the other intentioned traders in the market. And all of this stuff, all of these representations we look at are only as good as if they point us to those things. So how does the market move? And many of you are familiar with my work, but for those of you who aren't, just a quick summary here. I've talked about this in a lot more detail, and we do drill this down to to kind of unwrap a little bit of what I just said. We do take these principles and we look at how they show up in the market in terms of patterns and how we can trade around those patterns. But what we're really looking at is this fundamental nature of the market's movements, which is the market is always probing for trading activity. It's always looking at, if you look at a trading day as it evolves, the market's always exploring how many people want to buy above today's high, how many stop orders are resting below today's low. And this was very, very clear back in the days of the floor, when they would deliberately push to those levels to try to run stops. Nobody's actually shooting for your stop in the market, but in general, this is what the market is trying to do. It's probing for areas that would generate trading activity, generate volume, if you will. And if you think about it, it makes sense. It's very clear today that exchanges are businesses, right? I hope nobody's confused about that. And the exchange, every time a trade happens, the exchange makes a little bit of money. There's a fee associated. And so obviously the market would be motivated to go to those levels where it would find trading activity. And in the process of doing so, the market makes mistakes. Pull up a chart from today, pull up a, whatever, 2-minute, 5-minute chart, relatively low resolution from today, and look what happened after the Fed came out today. I don't have charts on this computer that I can pull up very easily right now, but you see multiple times we had moves in both directions that were overshoots, small mistakes, and followed by quick snapbacks. That's one of the fundamental ways the market moves. And then the flip side of that is sometimes the market will make substantial moves to new price levels and hang out there. And this is caused by a failure of liquidity on one side of the book, is a way to think about it. And the attribute that we see when the market is doing this is momentum. So what you will see here is that these conflicting factors, they absolutely are conflicting, lead to sometimes mean reverting moves and sometimes momentum moves. And we do have tools that help us to see when one type of action is more likely than the other. But if you just had to like sketch out on a napkin the essence of how markets move, what do financial markets do? This is it. I don't know anything that's a deeper truth about how markets move. And thinking, so what's this do to the game? What's the game? Well, you have this extremely competitive environment. Very smart, very motivated, very well capitalized people with great access to the markets and great tools are all trying to make money. So what happens here is that all of this human decision making, which includes an element of emotion, is baked into the market prices and into the way the market moves. This is true, and I know many of you are correctly going to point out that an awful lot of the trading today is computer trading. You are correct, but a lot of that computerized trading is still directed by a human. Everybody talks about the HFTs, but a tremendous amount of the algorithmic activity is a computer executing an order that a human is doing, maybe over many days in some cases. And the directional or the profit-seeking algorithms encode the human behavior elements into the rule set. Sometimes people like to say, oh, like show me the variable for emotion in your computer code. Well, it's not there, but it also is, because if I were to write, for instance, a simple mean reverting system that would say, if the market moves so far, and you got to define that precisely, of course, in one direction, I want to take a position in the opposite direction. Well, what I'm still doing there is, baking into it the emotion of that big move. So the flip side of that is that market prices provoke emotion, and that's why our theoretical unspoiled trader that I talked about at the beginning of this presentation, who's absolutely going to get slaughtered in the market as he or she does their natural inclination to trade. The reason that is going to happen with an unbelievable degree of regularity is because the movements of the market will provoke the wrong emotions at the wrong time in the trader. So the good news is, if you're experiencing this, and if you're trading, you probably are, you are completely normal. It does appear, by the way, that there is some very, very small set of humanity that does not experience what I just described. And there's actually some research being done on the overlap between that and different types of psychopath behavior. Something is seriously wrong with people who do not experience the same kind of emotional mistakes that normal traders do in markets. And it's an interesting thing to think about there. As I said, whatever edges exist are very, very small, and uncertainty and luck play a part in trading. This is the essence of the trading game as I've come to understand it over a couple decades in trading. And this applies, I think, with a almost universal, this is almost universal blanket here, that if you are doing deep value investing and buying a company, or if you're trying to scalp a 5-tick chart or something insane, I think that this applies. A little bit of, the specific application will be different, but this is what's underneath it all. So it's very difficult to make money trading. You got to have an edge. And if you don't know what your edge is, you don't have one, because you have to be able to do the right things in the market. If trading is a religion, it is not an orthodox religion. Do you know what that word means? Ortho, correct, and dox comes from the root that means to believe. It's not that you have the right beliefs. Trading would be an orthopractical religion, meaning that all that matters is correct action. Nobody cares what you believe about the market, and you can have all of the, and this is one thing that frustrates many traders who have diligently studied for years and years and years. There are a lot of people out there who probably have my equivalent or even, maybe even better knowledge of how the market moves. Maybe they know patterns and signals. Maybe they know the mathematics of money management. Maybe there are certainly many, many people who have a much deeper understanding of the math behind probability than I do. And these people might even know what they should be doing at any and every point in the market. But very few of these people are profitable. Why? Because all that matters is what you do when you get in, when you get out of trades at the correct size. And this is not easy to do because it flies in the face of human nature. And you know the answer to why. We just covered this. And any slight slip of discipline is going to lead to ruin because those edges are very, very small. And one of the main when you try to bridge this gap from having correct knowledge, and I think that a lot the work that I put out there between what's on my blog and the books and the trading courses and what we do in some of the the daily updates and the ongoing things that we do, I think we've done a very good job of giving people the knowledge that is necessary to trade. And then when you try to bridge that gap to application from belief to action, one of the things that gets in the way for many, many traders is the impact of randomness. And I'm becoming more and more convinced the older I get that the way we think about trading psychology and the way we address trading psychology is probably not quite right. And I think that I will say almost all psychological issues go back to one of three things. Many times these are combined: not having an edge in the market, past experiences and personality, so broader psychological issues, and then the third, poor understanding of randomness. So this first one here is interesting. I have had over the years many people come to me, and by many, probably 24 people with this specific situation, come to me for coaching, mentoring, counseling, advice, wanting to know how to get over their psychological issues with trading when they have been able to produce a very consistently losing record as a trader. And of course, what they're thinking is, not to mock anybody here, what they're thinking is that the source of their losses lies in their psychological issues, that they're struggling with fear, they're struggling with all of these issues. But as I've worked with these people, I started to kind of turn this on its head and realize that in so many cases, these people simply did not have an edge in the market. So first of all, do you have an edge? Do you have a reason to think that if you were able to apply your methodology with fidelity in the market, that you would end up a profitable trader? And that's not such an easy question. If the answer to that question is not a resounding yes, and then I would further ask you, why do you believe that? And I would then further ask, how certain are you of that belief? Those are important questions, right? And if you cannot supply very strong answers to those questions, then you need to at least contemplate the idea that you don't have an edge in the market. And your trading results might show that you don't have an edge in the market, because the market is the ultimate judge here. And if you don't have an edge in the market, guess what? You should have psychological issues, right? You should have hesitation and regret, and you should not feel good about your trading. So it's possible that, and I do think that there's a significant branch of the trading psychology issue that is trying to put a band-aid on this problem, trying to help losing traders feel better about their trading. And many of the people who are addressing these psychological issues they're frankly not qualified to address the question of whether a trader has a trading edge. And this is why some of the best people doing work in trading psychology simply will not work with traders who are not profitable traders, which I realize it's kind of a backwards thing. But this is something that, if depending where you are on your path as a developing trader. And look, folks, I want to be crystal clear. You can make a lot of money trading. You can absolutely change your life and change your entire universe through your interaction with the financial market. I am not being doom and gloom here, but you can't do that if you don't have an edge. And your edge is not an indicator or a candlestick pattern, so you gotta have an edge. Honestly, if you talk to me for a month about trading, I might just say that over and over. It's the most important thing that you can possibly be told about trading. Past experiences, personality. So there's a lot, there's a lot to unwind here, and it can be fixed. Personally, it was something I definitely had issues that I struggled with, and realizing that you have issues and figuring out how to solve them, that's not a trivial thing, but it's definitely worth doing. It's a little bit out of scope here. However, randomness is not out of scope here. So this is something I've not really talked a lot about publicly. I do have an outline for a book on trading psychology that I might write someday, but the time has not been right for various reasons. Writing a book is not a fun thing to do. That's a separate topic, right? But here's some things that I've come to realize. The key where people get confused about randomness is they don't understand the impact of runs in random selections. Now, there's a lot more, but it goes back to that. And if it's not an easy thing. Just to, let's get a little philosophical here for a moment. This way of thinking, what do I mean this way of thinking? The idea that chance and randomness can play a part in human events is relatively new. We only started really thinking about this in the 1600s. We only really got good thinking about this in the 17 and 1800s. So you have many thousands of years of human history and thought where people thought that we lived in a pretty much deterministic world. This is why you would go and, if something didn't work out, it was because the gods weren't pleased or something. This is, this drives a lot of early human thinking. And so this way of thinking in terms of probability, randomness, chance is so new, we really haven't integrated it at a very deep level. And if you also go back and you think on an evolutionary scale, there was probably very few evolutionary advantages to a human who could understand randomness, right? That wasn't really something, in our days as hunter-gatherers and early agricultural societies. It wasn't something that we really were selected for. It was not something that would, it meant. So we're just not very well equipped for this, and the people do not understand one of the things that you can do that, well, it's a silly exercise, but you can sit down and flip a coin and just keep track of how many times it comes up. And it doesn't sound like fun flipping a coin, but how many times you get heads or tails in a row. Because people don't understand this is when you're involved in the market and you have all this other garbage going on. And what I mean by that, I'm saying it with a smile, but you have all of the deception in the market, you have all the noise in the market, you have all the emotion encoded in the market, you have all of these things punching you in all of these different directions, and you don't understand that you're very likely to have 2 or 3 losing or winning trades in a row. And this leads to traders thinking that they're overdue for some kind of change. You don't understand that this also applies to market movements. You don't understand that having 3 failed breakouts in a row is kind of normal. It's just if this whole thing were random, and it's not, but if it were, you would just see that. So this results in a lot of cognitive misfiring and a lot of things that we give labels to, and we can talk about cognitive biases, whatever. But the issue is that it all goes back to this. Much of it goes back to this, and from this flows an entire cornucopia of behavioral errors and mistakes and things that cost us money. It's absurd if you think about the things that go back to this simple issue. And also, it is worth realizing that trading results aren't totally random. There's issues of environment that lead to certain kinds of trades being successful or not more often, and in some serial correlation. And this actually makes this worse. As I said, there's a lot to be done here. We can spend weeks and weeks and weeks talking about this, but just spend a little bit more time, perhaps, if you're in the process where you're putting all of this together, reminding yourself that you really are, even under the best and most disciplined conditions, you're at the mercy of some significant randomness here in the market. Okay, so discipline. Very exciting topic, right? You got to be disciplined to make money. Everybody knows this, and you've heard this so much, you're probably not even really listening anymore. One thing that I will point out to you that might be a little bit of a minor revelation to some of you early on, when I was struggling with a new market relatively early on, I said to a mentor that I was usually a very disciplined trader, and I got a I got a very pointed and direct response that pointed out to me that if you're not disciplined at every moment in every interaction with the market, you are not a disciplined trader. So that's one thing to think about. If I say give yourself a discipline score, what's your discipline score as a trader? And you might be like, nah, I'm 85%, or I'm 95%. And you think that's pretty good, right? I mean, 95% is pretty good in most things, but it's not here. You're not a disciplined trader. And the issue is that 5%, or maybe even the 1%, or the fraction of a percent where you're an undisciplined trader, one of those events can cost you your entire trading account. So you really must focus on discipline, with the idea of being disciplined at every moment. Every moment. And we think about this, of course, where am I going to get in? Where am I going to get out of trades? Like what size am I going to trade? But it also has a lot to do with you doing the work. When I get done with this presentation today, I got to log a bunch of stuff. I got to do a lot of work, my daily work, setting myself up for tomorrow's trading. I got to do that every day. And I'm really not going to want to do that, because I just finished a kind of exhausting trading day. Now I'm talking here for an hour and a half, and I would just like to go eat a steak and drink a glass of wine and call it a night, but I don't get to do that. And it's doing things when you really don't want to do them. That's where discipline starts to get real and useful. And of course, this is not so easy to do, but I think that we can go down. It's one thing to just scream at yourself over and over, be disciplined, be disciplined, be disciplined. It's not the best way to do it. I don't think and you can, different personalities respond to different things. I respond to some pretty rough self-talk. Not everybody else is like that, but if you, most people could not handle the full metal jacket drill sergeant I have in my head most moments of most days. But that works for me, and I can kind of laugh at the absurdity of it. But it's also useful to think about this problem, this discipline problem, with some understanding, right? Rather than just bashing a problem with a sledgehammer, it's good to think, is there something we can understand here? And if you spend some time mapping out really what you can and cannot control, randomness, right? That's I wasn't wasting your time with the discussion on randomness. You realize that so much of this is really out of your control. The if you understand that, then you start to get very focused on, okay, well, wait, what can I control? What am I responsible for? I'm going to show you some specific examples when we get to my rule set here. Once you do that, you can start thinking in a more constructive way, how can I be disciplined? And realize, of course, not everything is equally important. Some things are monumentally important. The things I have to do after this presentation are monumentally important. Not every single thing is, but me checking my trading size before I put on every trade, that's pretty important, right? So you got to figure out, like, what are the most important things you got to do. And it's also a good idea to build in some accountability. Over time, your P&L will do that for you because the market is the ultimate judge. But this is why it's a good idea to have a trading buddy. It's why it's a good idea to journal. That's a kind of accountability, right? One of the things that I realized early on when I had a let's say a richer and more extensive journaling process, you can't maintain that forever, but I actually found that because I was being very disciplined with my journaling, that there were times that I was about to do something stupid in the market, and I thought, wait a minute, if I do this, I have to write it down. If I do this, I'm going to have to explain to myself what I did, and I don't think I'm going to do the stupid thing because I don't want the pain of writing it down. Now, that's a pretty constructive outcome, right? On one hand, it's a little bit absurd, but that's the way brains work. And so even the simple accountability of journaling and explaining, if you have a moment where you're about to do something dumb and you don't do it because you're going to have to journal it, that's a pretty good outcome for a journal. I just spent some time here talking about self-talk. So let's jump into the promised rule set. And there's some rules, if you Google Adam Grimes trading rules, you'll see I wrote several articles, and some of these are drawn from that. But I want to talk through these. And some of these are a little bit different, some of these are new. Do be aware that these are my rules. I think a lot of what I just spoke about here for the past 20 minutes or so are probably relatively universal rules. But the rules I'm going to show you next apply to me, and I'm a primarily directional trader. I'm a discretionary trader. I'm a swing trader, and what this means is that I try to not give back too much on any trade. I'm not interested in enduring a lot of pain on trades, though I'm very good at that when I need to be. It's not what I seek. I'm focused on mostly short-term edges. I tend to hold trades for 10 to 20 bars, though I'm capable of holding for a lot longer. And I do trade reasonably aggressive position sizing. So what this means is that mistakes, when they are made, are significant in terms of P&L. You may be different. You're probably different on a lot of these. And understand that what I'm about to tell you next, though, applies within this framework. So what are my rules? So always use correct position sizing. I know that I can do enormous damage to my trading account if I violate this rule. There's never any reason to trade too big. And at the moment, it seems like there are some great reasons. You will see a setup that's the best setup. You will, one of the best ways you'll get yourself in this situation is, and by best I mean worst, let's say you try a trade. Let's say you just know the market's going to go down for various reasons, and you had a little short and you lost, you had a little short and you lost, a little short and you lost, and then you have a short and you're right, and it's clear you're right. Well, first of all, you're going to feel some regret because you wish you were bigger, but then you're going to feel the urge to get bigger. And at least within my framework, that's a mistake because I'm probably big enough. There are ways that I can get big and pyramid into more extended moves, but they have to be done correctly so that my position sizing is never violated. I'll talk about that specifically in a moment. Match entry technique to market structure. So what I mean is, I said I'm primarily a pullback trader. So if I'm going to trade pullbacks, I'm trading pullbacks in trends. Therefore, you can see where I'm going, right? I need to have a reasonable degree of confidence that the market is trending. And if the market is trending, the assumption that I'm going to make by making this trade, it's an experiment. Every trade is an experiment, but the assumption I'm going to make is that that trend is going to continue. So the problem comes though, if the market is clearly not trending and I trade a pullback, that is inappropriate. I need to apply a different technique to that kind of market if I wish to trade it. One of my other rules is don't be a dick for a tick. And I really try to clean my language up for public presentations. Again, if you could hear between my work history, working, spent some time as a professional chef in a professional kitchen and being on various trading floors. I have a very colorful vocabulary that I try to clean up for these, but that's particularly meaningful for me. There are times that I'm like trying to buy the low of a move or something, and I just can't get filled, and it ticks at my price, and I can't get filled, and so then there's this voice in my head that says, "Don't be a dick for a tick, just get into the trade." You're going to make, if you're right on this, you're going to make tens and tens of ticks. So why are we worried about one? And there's certainly something to be said for trading efficiency if you're a more active trader. But still, one of my rules is get the trade on, and often this even means just doing the trade at the market if I need to. One of the other rules is that I will always have stops and targets in the market, and they're entered sometimes maybe not a target, but if I always a stop, and these orders go in when I put in an entry order, and the stops and targets are OCO'd. So there will never be a time, I shouldn't, you gotta be careful with never, but there would only be very specific times and points where I would have a position floating so that if I became incapacitated, that position could theoretically become an infinite loss. That doesn't happen because I have my exit orders entered OCO. And what OCO means for newer traders basically means one order will cancel the other. So if one order is filled, you get in, and then you'll have this pair of orders, this pair of linked orders that go in. Most of you know this, but you have a profit and a stop, and when one is filled, the other one will be canceled. Or if I should happen to cancel one, the other one would also be canceled. That's usually what OCO means. If I'm pressing for a larger win, only do so in a clearly trending environment. So, there are certainly times where, imagine that you've had that you've had maybe a couple losing trades, and then you get a trade that is winning and it looks pretty good, and gosh, wouldn't it be nice to make more money here so we can erase the losses? Well, nobody cares. The market doesn't know or care that you had two losing trades, so you'd like to have a larger, who cares? But there's a very natural human thing to do, to either increase your size or to try for a bigger profit target, which, by the way, is going to coerce the trade to a lower probability trade automatically. It's axiomatic. So the only points where I can ever press for a larger win has to be on partial size, and only when the market is clearly trending. This is a big one. One of my favorite trading rules to hate is nobody ever went broke taking a profit. False. I personally blew up a trading account as I was learning to trade a specific market, and I blew it up with very high probability trading. I was right over, I don't remember the exact numbers, but it was far north of 80% of the time, and I took a lot of very small profits, and the account eventually went to zero over quite a few trades. You absolutely can go broke taking a profit. You can go broke, you can bleed to death from 1,000 paper cuts. So one of the things, and what I find with developing traders, usually one of the last pieces of the puzzle to come together is being able to hold on to your winners. So never, ever exit a winner without reason. What are reasons? Well, reasons could be here. It depends how you trade, right? In my case, reason is the profit target's hit. Profit target's defined with several ways, but a reason could also be, clearly conflicting price action. Reason could be, depending what kind of trader you are, maybe you saw something on the tape that pushed you out of the trade. But you got to be careful with those sorts of things, because the less clearly defined your rules are, the more easy it is to just kind of make a knee-jerk decision, get out just because you want to. On the other hand, so never exit a winner without reason. When I'm wrong, get out. When I'm confused, get out. If I am exceptionally emotional, I've been doing this a while, it doesn't happen very, very often, get out. If there's something happening in the market I don't understand, get out. And those kinds of rules, shoot first, ask questions later, as far as the trades are concerned, those have saved me a lot of money and losses over the years. Never ignore a stop, never cancel a stop. I won't say that, I would have said years ago that never move a stop in direction of risk. And there are times, frankly, when you should move a stop in the direction of risk. Make sure that you understand within your own trading paradigm when you could do that, when you should do that, and also be prepared that if you do that, there's still a very, very good chance that you're going to have bought the exact high of the ultimate bar that forms there. It happens with a remarkable degree of regularity, or conversely with the low. But certainly what you can never do is have a market get close to a stop and then you cancel the stop. Or if you're using mental stops, and a friend of mine likes to say the reason they call them mental stops is they will make you mental if you use them. But many people don't want to put stops in the market for what I think are mostly wrong-headed reasons, and they'd rather have an alert or something than they have to go execute the trade. Fine. On the other hand, let's say you're an options trader, you should probably not be putting stop orders in on options contracts, I think, on the actual contract itself. But if you're in that situation where your stop is triggered and you don't execute, that's a no-go. You can't do that. One of my rules is only add to a trade under two conditions: a working trend trade where you do not load risk. And just to be clear, what I meant by that is, let's say we have two parts to this, right? It's a working trend trade. So we have a move and we have a pullback, and I bought the pullback, okay? So I am fully long here, and I sell part here at my first profit target. And then the market makes another pullback here. So what I can do now is I can take this trade. I can take this trade full size because my stop here is now raised enough that if I happen to get into this trade and it turns out to be a losing trade, I'm going to suffer a loss on this trade, but I'm also going to suffer a partial loss on the piece of this first trade that I'm still holding here. However, that partial loss is going to be at a price that means that the net risk budget for that trade is not greater than an initial risk. That's what I mean by not loading risk. The other way that I am allowed to add to a trade is a counter trend trade. So, let's say, I know you might be saying never trade counter trend. So let's say we have this market here, and let's say we buy here. Is that a counter trend trade? Well, we're hoping not, right? Because we're hoping it turns into a pullback. But at this exact moment in time, the market's in a pullback, the market's in a downtrend. So, and I just bought in a downtrend. So you see the issue, right? I'm counter trend to the short-term trend. So, there might be a case where I might buy a partial, and then the market might do this, and I might end up buying more later, but I'm only allowed to do that if I am not yet full size. What I certainly can't do is buy my full size here and hold it and then end up buying here, so I'm double size. It's stupid, can't do that. Responsibilities. I am responsible for risk management, partially what I just discussed, a little bit more. Money management, trade management. I got to put the trades on, I got to take the trades off. I'm responsible for executing. I'm responsible for doing the analytical work. I'm responsible for doing the work on the market, looking at my trading results. I'm responsible for looking at myself and saying, am I okay? You know, is there anything I need to do to fix myself? Am I okay to trade? But I'm not responsible for, critically, I am not responsible for the outcome of any one trade. And some of the things you see here are on my trading rule sheet. I have a reminder that markets are highly random. I don't have a crystal ball, and I'm not as smart as I think I am. So this brings great clarity when you have the perfect setup and you put the trade on and you wait and you wait and it starts to go in your direction, and then it collapses and it turns into a losing trade, and you're feeling, you know, naturally you'd be feeling frustration, dejected, whatever. But I'm not responsible for that. It's the outcome of a random trade, whatever, right? I'm also not responsible for the outcome of any string of trades. And so it's very easy to say, and I say that, and you probably say, yeah, okay, fine. But until you have deeply embraced this, you're not able to that easily say it's not my responsibility. These are more of my rules, you know, doing the work. Mise en place, some of you know that that's a kitchen phrase that basically means you do all your setup before service starts. If you do that, you know, you look at a chef station in a top flight kitchen and you see everything is very neat, everything is you know, like little dishes prepared, knives where you need them, work area clean. You do all of that, you're going to have a really nice service. You might even experience a peak flow experience. It's you know, it's a great work environment. You don't do that, you're going to have an absolute nightmare, and you're going to spend the entire night in the weeds, and you're going to go home not feeling very good. And it's the same thing trading. If I do my mise en place, if I do my analysis the night before, if I come in the morning and I look at the overnight market structure and I know where my relevant levels are, and I know where the big trades are on higher time frames, and I know how related markets are moving, if I do all of that, I'm very likely to I've put myself in the position where I could have a good day, conceivably. But if I don't do that, you know, if I'm just coming back from vacation and I'm not really in the rhythm and I haven't done all my work, and maybe I have to do a PowerPoint presentation, and maybe I have some phone calls, I have like all these distractions, and I've not really created a conducive work environment, I'm probably less likely to have a good day. And you realize this over time, but this preparation. So what mise en place, all, you know, all it could mean, you could just say proper preparation. That's what this means. Fix mistakes immediately. That's one that's attached to the side of my monitor. You know, there's a lot that we could say about that, but it's just very, very simple. What's the mistake? You're too big. You got out too early. You missed a trade. Fix that immediately, whatever it is. And, you know, I mean, there's a little bit of nuance. You missed a trade, you don't necessarily bang into it whenever, but whatever, as soon as you've identified the mistake, fix it. Do what I need to do to take care of myself, you know, and this, you know, again, like this is very personal, but what do you need to do in terms of diet and exercise and health, mental capital? Actually, this one didn't make it onto the list, but one of my other rules is that mental capital is as real as financial capital, and you got to preserve both. You know, I am a person who I'm capable of working with obsessive focus for quite a long period of time, but you got to decompress from that in some ways too. Risk management is the first and last responsibility. Again, I apologize for the language, but this is what's on my rule sheet. I can fuck anything else up and probably be okay as long as I don't fuck up my risk management. That's that blunt. And what that tells you is that you know, one of the worst mistakes you can make is to get too big. That's the classic way that traders blow up accounts. Opportunity comes every day. I got to do the work every day. Get out of shitty positions. You know, how many times have you had a position on and you look at the damn thing every day on your trade sheet, and it's, you know, it's not at your loss, it's stop loss, so you can't really get out. You've tightened the stop. The thing looks like garbage. It's probably not going to work. Now, there is also a certain amount of enduring pain and patience, and so you got to kind of figure out, like, you know, like, where's that happy spot. at some point, this is a such a feeling of relief to me when I put this on my rule sheet. Just, get out of bad positions, move on, learn, grow, expand. I'm always reading something. I'm always looking at some bizarre, you can't even imagine Tom, my trading and business partner, you can't imagine some of the things that he has to endure listening to me talk about as I get into some things trading related and some things not. And a lot of these things turn out to be kind of dead ends, but some of them don't. And the few that don't make it all worth it. So I do think that part of what's going to make you successful in this business is a commitment to literally lifelong learning. If you have questions, put them in the question box. I have a few more things here. I want to tell you a little story. This is also, so despite all of this talk of being perfectly disciplined every time, every interaction with the market, there is still sometimes where you're about to do something, you're not sure if it's dumb or not. And this is a good rule to have. If you think you're going to do something stupid, at least do it on smaller size. You can't get bigger than you're allowed to get, but you certainly can get smaller. And there's also very good reason for this, because sometimes you can't read a market. At least I personally can read a market a lot better if I have on a little bit of risk. Doesn't matter what that risk is. It can be a tiny, tiny, tiny position. But as soon as I see my P&L move, I have a different part of my brain is engaged, and I understand the way the market is working in a different way. So I hope this is useful. I hope this is helpful. You really have to create some kind of structure that will shape your behavior in the market, because the market is the ultimate scale of justice. Now, let's talk about justice here for a moment. Drop your questions in the question box. So you see here a statue of justice, right? And what does this mean? For most of us, like, you go to big cities and you look up and you see statues like this, maybe in marble, and it gives us some confidence, right, that bad people will be judged, and so we're protected by the rule of law. It also maybe is a reminder to us, if you're tempted to break a law, like maybe you think about this and you won't. That's a valid way to think about Lady Justice here. And we see, of course, she's blindfolded, and but what we don't realize is that's a very modern addition. I think the blindfold was put on her sometime in the 1600s, and you go back to and we know, of course, this is a Roman goddess, right? And we know that this Roman goddess was worshipped because she had the ability to see into the future, and would, in a deterministic world where there was no randomness, you could petition the goddess for good things. And this Roman goddess, of course, was an outgrowth of an earlier goddess from the Greeks, and that was Themis, who actually was a Titan. And mythology is, of course, very vague, because not for the least of reasons, somebody burnt down a library because they wanted a statue out of it. But so we lost a lot. But if you really go back into the beginnings of these myths, you might have discovered that this goddess of justice was a Titan who lived in Tartarus, which was the underworld to the underworld where even the gods feared to go. So if you went down in this like very deep, dark place, if you drop an anvil from heaven, they said, it would take 9 days to hit the earth, and the underworld was that far below the earth, and then that far below that was this very, very dark place where you would encounter this goddess with a sword and a scale. And that's so we think about justice as being what's right and what's just, but that would have been a terrifying place to meet this creature, right? And by the way, this goddess that carefully balances and weighs things, she also has some siblings who were in fact the embodiment of primordial chaos, who had 100 heads and 50 arms, I think. So this was, all of this goes back to much deeper and darker ways of thinking about consequences. And if the market will do this to you, the market will grind you down, the market will judge the result of your actions over many sets of trades to be worthy or not. And the only chance you have of being judged worthy is to have a rule set that shapes your behavior in the right direction every time, every interaction with the market, because the market's that ultimate sword of justice. If you are new here, I'd love to have you check out what we do at Market Life. You can pop. I'm going to do Q&A, so drop your questions in there if you have not already. But we are currently running a pretty good discount, 20% off your first payment after your trial. And this would obviously be, you get 20% off a year, which is the best possible deal. But, we apply these concepts and these ideas that we've covered today. This is underneath everything we do. And you get to see how I think about these things and apply these in the crucible of learning in the real market every single day. So it's I really, honestly, I very much enjoy producing the material and interacting with our members, and we certainly love to have you there. So go check out marketlifetrading.com/deals, and if you use that link, you will automatically receive 20% off your first payment. Okay, so let's jump into your questions. Will we be sharing slides presentation by any chance? The presentation will be available on playback, and we probably won't be sharing these slides. Excuse me while I read these. Well, this is interesting. Thank you, Charlie. This is not so much a comment, but he just said it was a major benefit spending a year as a Market Life member with my daily commentary and other meetings. I went through most of the courses and archive meetings. There's a lot of wisdom there. Do we have any plans to create a futures course? I don't think we need a future specific course, but I will tell you, Tom and I are trading futures much more on recently on different. Our focus has shifted quite a lot from stocks to futures, though we're certainly in currencies too. Of course, we're very aware of all of these markets, but there may be something that grows out of this at some point in the future, Charlie. Not in the immediate future, but there, and we may also do something with some different time frames as coursework, but I don't know is the short answer there. What's a specific edge versus a pullback edge? Well, I would say that pullbacks, so a specific edge just means that if you execute a trade over a large enough sample size, that you're quite likely to have more money than you made than you lost. So you make money. That's one definition of an edge. It's not a particularly useful definition if you're trying to craft an edge, but a pullback is the market structure of a pullback, of a market making a big trending move and then pausing before making another move in the same direction. That's an example of one of the kinds of market action where we're able to set up trades that actually have an edge. If you break rules, how do you fix it? With a rule to not break the rule, but then you might ignore that and you might go on tilt. How do you stop going on tilt? What are your thoughts on monitoring your personal state as emotion, and can it affect your action as it reacts to your rules? Graham, this is a really good question. I think this kind of came in the middle, so maybe we address some of that to some extent, but so if you break rules, how do you stop breaking rules? Which, the question you're kind of asking is, how do you be disciplined? Well, there are a lot of different ways depending on the person's personality, the trader's personality who's struggling with this. One, you can try I would first of all put this intellectual stake in the ground. Like, you got to realize this. If you break rules, fine. Everybody breaks rules. There's no sense, ripping yourself to shreds over a broken rule. Because if you keep doing that, the market's going to do that for you, okay? Let's just be honest. You don't have to do it, the market will punish you. But let's try to avoid that, right? So one of the things you can tell yourself is that's absolutely true. If I keep breaking my rules, I'm not going to be able to be a trader. That was one of the realizations that snapped it into focus for me early on when I was having some trouble sticking by my rules. I realized after a particularly nasty loss that was related to not following my rules, I realized if I keep doing this, I'm not going to be able to be a trader. And I really like this game. I want to do this. So how about I'm going to stop doing stupid shit? That was basically my profound revelation that drove me to a commitment to become a disciplined trader. So, and I think, so, you might say, well, that's not, so what, right? But I think a lot of people don't realize how important this is. So first of all, make sure you do. And then how do you keep yourself from breaking rules? Well, there are a lot of ways. I mean, we can talk about a lot of different kinds of conditioning. We can play a lot of psychological games. Sometimes simple things work. You can use positive and negative reinforcement. These things are real. Like you can train yourself just like you train a dolphin, but you really have to do it within the right degree of structure, or you can work with somebody who can help you do that too. Let me just read through some of these. Somebody, I've heard about adverse selection, and this person meant that due to competition, you have limited time, limited liquidity to place trades for something plays out. Do you think it's true? And give some examples. I don't know. I mean, it depends on your time frame, right? There's yeah, there's a time for every action. And there definitely is a moment. And for every trade, there is a golden edge where you wait too long, it's too late, you're too early, it might not happen. And so yes, there definitely is a pivotal moment for every trade. But this person sounds like they were trying to create some anxiety with that. It shouldn't create anxiety. Like just trade your rules. There's a whole industry devoted to telling people no edge, they have bad psychology. Yes, you're right. Thank you, Coleman. And I will tell them they should. They should have bad psychology. That's what no one will tell them. My edge is market life. I understand. Thank you. I understand my behavior, random events. I think I'm on the right track. Thank you, Mr. Grimes. Thank you, Dale. I think you're on the right track too. Thank you. That's a nice comment. Post more blog posts about psychology while you wait for your book. I apologize for the lack of blog. I apologize to the universe for the lack of blog posts. There are good reasons for it. It's because my brain is engaged elsewhere. I will try to post more though. Thank you for the poke there. Does it make sense to have meta rules? Example, only edit your rules after evaluating data for X number of trades. Yeah, it's a good rule. I think that is a good idea, because obviously, in the limit, imagine you're changing your rules instantaneously, constantly, then you don't have rules at all. On the other hand, it doesn't make sense for instance, it doesn't make sense for you to just randomly take this list of rules I gave you and apply it to yourself. So, there's some correct degree of modification and learning where you're figuring out how and when to change your rules. I think that's a very good idea. Good point. You mentioned that this is from James, mentioned you place your stop orders in our market, but many advise not to enter your stops in the market. What are your thoughts about that? I put my stops in the market. I don't care if you want them, come and get them, whatever. My stops are in the right place. My stops are in where they need to be. And if no market maker is going to run to get my stops where they are, and if you come and get my stop, I'm wrong, and whatever, it's fine. I don't care. How does a newbie go about finding an edge, and how do you know what an edge is truly valid? That's a big question, right? And I think I've written and talked a lot about that, but I think, and I'm not selling you anything here, but I think start with the free trading course I have out there. There's a lot of work on my blog that will, so understand how markets move, think about how you might trade around that. You do have to define some rules. They're probably going to be based around some kind of pattern, and you either see what you can back test and then forward, and don't trust any back test. Don't trust any back test anybody else gives you. You should almost completely disregard, and if you did it yourself, you should almost completely disregard it too. But it's a good, you got to do it to learn, right? And then trade small and keep track of your results. That's really the process. And I don't say that in a flippant way, but if I was going to give you a full answer, it would be many hours. When you back test, do you back test your full strategy, or just the statistical tendency of the pattern reaching 1R? A lot of different ways to do it, but then there's a case for, depends again how you're trading. As a discretionary trader, ultimately my full approach includes stuff that is not back testable, but is a statistically structured, as a very structured discretionary trader. I do rely on the pieces of the puzzle having a statistical edge. So that's primarily what I back test. What do you think? What about scalping, taking lots of small base hits? Have you found any success in scalping futures? Yeah, it's not really how I want to live my life. I did it for a while. I was doing tens of trades a day at one point back in the early 2000s. It's a personality question, and of course, like what's scalping is kind of a question too. But there's certainly something to be said for hitting a lot of singles, Robin, and that's a valid approach. But I think trying to trade too much, I think like if you're trying to do more than a dozen trades a day, it's probably a little bit tough. Jim says these are practical and relevant. Thank you for making them clear. Sometimes common sense to be found is common sense. Thank you. Yes. You're welcome, Jack. Raj says, when it comes to position sizing using percentage of capital method, do you calculate risk amount using starting capital or total buying power, including margin? Yes. Yes to either one of those. You do it consistently the same way. I mean, I guess I would not, well, okay, wait, sorry, unwind that. So the question is, do you calculate risk on the capital at the moment of putting the trade on, at the beginning of day capital? Do you include open trades or only closed trades? Those are the kinds of questions you need to unwind. I would not include margin, so I would just include capital, but there's still some questions to be untangled there. What are your conditions to identify a trending market before looking for pullbacks? Joel, I've written and talked about that a lot of different places, but basically you want to make sure you want to make sure it's trending, and you want to make sure it's not climactic, that you don't have any potential warnings of end of trend. Do you think someone's at a disadvantage if they cannot pay attention to intraday action? No. And can only add orders, adjust stops once a day after market hours? No. I think for many, many traders, that would actually be an advantage. So I don't think you're at a disadvantage there. A lot of traders, I say this as somebody with a decent awareness of intraday trading, to say the least. I think most traders would probably do better if they didn't look at intraday data. What setups tend to be the best pullbacks? Again, like I've talked about that elsewhere. Sorry, it's just I just can't. Is there any point in trading FX on lower time frames, although there can be more noise? Do patterns work on all time frames? To some extent, markets are fractal. The correct thing, I think, is to say the markets are fractal-like. That's a little bit more accurate. Patterns are similar on all time frames. So let's not say the same. Let's say similar. So I think I hope that answers your question. Richard, I'm just reading. Yeah, so the question is, what's my view on having very black and white rules for an entry trigger, having more general rules for setup? I think that's okay. I do think there are things that you can't quantify. And I think that's okay, but I think newer traders probably need to be a little bit more structured. And I think more experienced traders are, generally speaking, going to be a little bit more comfortable with maybe being a little bit less structured. Is it normal to have a losing year? Well, it depends how you trade. I mean, like the very different situations. Like if you're an active intraday trader and you just ask a question about intraday trading and you had a losing year, what that would suggest to me, I would say with all possible respect, is that you probably haven't found your edge yet. And that's okay, but you got to know that you don't have your edge yet. And if you're an intraday trader and you are, you've had a losing year, you probably don't continue doing the exact same thing. Let that be. That should irritate you, right? Your losses are very, very valuable. Your losses are a precious gift from the market. Your losses are, not to get too poetic, but like think about that sand that is in that oyster that's going to provoke that oyster to make a beautiful pearl. That's your losses should be an irritant like that. But you got to address them properly and you got to do the right thing with it and let them be a provocation for you to reevaluate what you're doing. On the other hand, some traders, like, yes, you may very well have a losing year. That's certainly possible. Jim has a question about, Jim, the currency trades are in the futures, and we actually we just had a couple yesterday, so you should have seen this, but we do them as futures, and you certainly can execute them with cash. Dale, this is a pretty good summary. Dale says, have an edge, have a risk management process, system with feedback for continuous improvement uh, for the goal, which is usually profit and positive life-changing outcomes that are positive. Forgive yourself for any black swans that fly into your domain, not just black swans. Like I would look at black swan and say, could I have protected myself? But also don't get too beaten up for just normal losing trades. Make the best of it if you can. Do I model my trades on the past and paper trade them in the future before you use them? I personally, I tend to trade small rather than paper trade because it engages my brain better. Do I follow headline action? I mean, I'm aware of it, but no, I don't. I don't look at news. I don't think there's any edge to be had for following and trading news. I see you're primarily a swing trader. Does it mean you never day trade? No, I also do day trade. And I spent many years of my life as a focused day trader. On a personal level, what time frames, instruments do you typically trade? I have traded everything, Jim. Right now, we're very focused on trading futures on several time frames, and by futures I mean literally the full range of U.S. listed futures. And also, yeah, I've been doing a good deal of short-term trading too. Have I found I need to write all my rules down? Fuck yes. Okay, yeah, that's my reaction to that because I know what my brain does. The question is, Daniel's asking, do I need to write them down for myself or do I just write them down for you today? Did my psychology change when I wrote them down? There's no way I will have in the heat of battle the discipline to follow a rule that's not written down. Hopefully if I write them down, I can follow them. But, it's comical to think how helpless I would be if I was just trying to, like follow these nebulous rules that are not written down. No chance of being successful. How often do you trade the failure test pattern? I use it every day. All rules go out the window when I'm on tilt. Any suggestions how to monitor tilt? Well, when you're on tilt, stop trading. You got to make yourself walk away. Nothing good is going to happen. I wrote about some ideas to do that in my first book, but a good way to do it is just have a rule for maybe a number of losses in a row. And if you hit that loss, I don't know, if you're a day trader, 4 losses in a row and you're done for the day. But then you got to respect it. That's a problem, right? With being on tilt is when you're on tilt, you're literally not in your right mind. Your brain is chemically compromised. So you're not capable of making good decisions. And the problem is that you'll just ignore your rule, but you got to make yourself quit. Okay.